Following on from the last video, I want to look at the sell-off in the 10-year bond yield and relate that back to sector performance in the Australian equity market. So choosing a regime, as we call them, sharp sell-offs. The sell-offs that we're looking at is the 94, 98, 2003, 09, May 13 to the taper tantrum, and then March 15 where bond yields here, that's the black line, bottomed out at around about 2.3 and have risen close to 3%. So we're interested in equity market relative performance in total return terms. So I'm looking at banks at the moment, and you can see here banks, if I include most recent data, have underperformed the market by around about 8% over this sort of first 2-month period of a bond market sell-off. That's as much as what occurred during 2003, although you can see the behaviour of banks in rising bond yield environments has been quite mixed, certainly since the 1990s. If the underperformance was due to the rise in bond yields, then we would expect to see the same impact being felt in other interest rate sensitive sectors, other high yielding sectors. So if we look at those now in turn, we can see property trusts. And while property trusts typically underperform, and they have underperformed in previous bond rising cycles of somewhere between 15 and 20%, except for 1994, we see the black line there that the current outperformance is quite unusual. Likewise, telcos, flat to down as the probably the more usual experience, and that's what we're seeing there at the moment. So it's not underperforming. Utilities is one where you would expect underperformance in a rising bond yield environment, and once again utilities have actually managed to slightly outperform the market, up about 2% in this 2-month period compared to on most other occasions except the 1994, where they've underperformed by somewhere between 5-10% over the first 3 months, and even more than that going forward. So it would appear that this is not just a blanket move against interest rate sensitive sectors, and it's much more specific, is one of the conclusions that we come to, and that's would seem to be fairly obvious in the case of banks being undermined by the potential change in capital requirements, balance sheet, and also some poor results out just recently. But it may not be just because of these bank specific factors that we haven't seen a major rotation out of the higher interest rate yielding sectors into the other parts of the market. And the reason for that is that there's, at this stage, there seems to be very little commitment to this interest rate move, in the sense that the sectors to move into aren't that well loved by the market in any case. So let's just have a look at some of the other sectors that typically do well in rising bond yield environments. Now, you first obviously would go to materials, and materials which includes the miners, actually, as well as some of the building material stocks. They have outperformed, but it's not as if the market is fully committed, we think, to the view that the mining sector is going to outperform. The other sectors that would potentially do well in such a rotation out of the interest rate sensitive sectors would be retailing, and certainly we have seen an outperformance, partly because of the this rotation, but also I think the budget has also had a positive impact on the retailing sector. Diversified financials is another one of those sectors that has benefited as the market overall tends to rise in those early bond yield rising environments. So what might it take for investors to have more conviction in this rotation out of interest rate sensitive into the cyclical sectors? Clearly, it means investors have become more confident with an improvement in the domestic economy and in the global economy. Starting with the domestic economy, if we look at a couple of the key cyclical indicators, one of which is consumer sentiment. Now, what we've found previously in these periods of rising bond yields, it's also been associated with a period of increasing consumer sentiment. As we can see here on previous occasions, we've seen consumer sentiment lift by somewhere between 10 and 12% over a 4 to 5 month period. Now, this week we had news that consumer sentiment actually did lift in the month of May after a fall in April, and that's welcome news and evidence that possibly we're moving in this direction, but it would require a further lift, a further significant lift in consumer sentiment to provide investors, I think, with more conviction around the more cyclical story. Another couple of indicators that we would look at would be some of the more discretionary areas within retail sales, one of which is clothing. During past bond sell-offs, you have seen clothing retailing actually lift quite sharply by as much as 5 to 7% over a 3 to 5 month period. So we don't have the data on that series at the moment, and will be somewhat lagging, but that will be a key area of discretionary spending that we would be looking at. And likewise, expenditure or turnover in cafes, restaurants, catering has typically also been quite a strong performer during those phases. Of course, an improvement in the global cyclical story would also be necessary to sustain this shift out of interest rate sensitive and into the cyclical areas. So if we have a look now at, say, the ISM New Orders Index, and you can see here that in the past we've also seen quite a sharp lift in that one. If we look at the chart in this format, the shaded areas in blue are the bond sell-off periods, and the line behind that is the ISM, the new orders component. So, as one might expect, a rapidly rising ISM index has often been associated with rising bond yields. So we are at the very early stages. You can see here we had a little bit of an uptick in this indicator in April. It'll be very interesting to see how the May number comes out when it's released at the end of the month or early June. Of course, another very good global indicator typically is the IFO survey out of Germany, the expectations index, and that has also generally been associated with, big lifts in that index have been associated with rising bond yields, and also, as we saw earlier, a rotation out of the domestic interest rate sensitive sectors and defensive sectors into the more cyclical sectors. Thank you.